Jiuzi Holdings, Inc., NASDAQ, JZXN, a prominent provider of intelligent charging infrastructure for new energy vehicles in China, has announced a significant strategic shift with the adoption of a crypto asset investment policy. This decision, approved by the company's board of directors, allows for the allocation of up to $1 billion in crypto assets, specifically Bitcoin, BTC, Ethereum, ETH, and BNB. This move follows the appointment of Dr. Doug Buerger, a renowned crypto expert, as the new chief operating officer. The policy is designed to enhance long-term shareholder value by leveraging crypto assets as a hedge against macroeconomic uncertainties, rather than engaging in short-term trading. The investment framework emphasizes a controlled risk exposure with stringent asset selection criteria and top-tier custody standards, ensuring that Jiuzi Holdings does not self-custody its crypto assets. A newly established Crypto Asset Risk Committee, led by CFO Huji Gao, will oversee the implementation of this policy and report to the board. This initiative aligns with Jiuzi Holdings' broader strategic objectives, including supporting China's carbon neutrality goals through the deployment of smart charging infrastructure. The company plans to disclose material purchase activities related to this policy through Form 6K filings with the SEC, maintaining transparency with investors.
Eastman Kodak Company, NYSE Kodak, is taking significant steps to address its financial instability by terminating its overfunded pension plan, which is expected to generate over $500 million by December 2025. The company plans to utilize these proceeds to pay down term loans, reduce interest expenses, and stabilize its balance sheet, thereby improving cash flow. This strategic move comes in response to a recent going concern warning, highlighting Kodak's financial vulnerability. Additionally, a major preferred shareholder has converted their shares to common stock at a premium, eliminating a $123 million liability and signaling confidence in the company's future prospects. Kodak's strategy also includes a pivot towards pharmaceutical production and advancements in battery technology, positioning itself to capitalize on shifts in U.S. trade policy. This diversification effort is crucial for Kodak as it seeks to redefine its business model beyond its traditional photography roots. While these developments offer a potential path to financial recovery, risks remain, particularly in executing these new business ventures successfully. The market's response to these changes will be pivotal in determining Kodak's long-term viability and investor confidence.
Decentralized perpetual futures exchanges, perpdexes, are gaining momentum in the cryptocurrency landscape, heralded by Changpeng Zhao, CZ, of Binance as a pivotal development in decentralized finance DeFi. These blockchain-based platforms allow users to trade perpetual futures contracts without a central authority, offering benefits such as self-custody of assets, transparency, and censorship resistance. The growing interest in perpdexes reflects a broader demand for advanced trading tools that provide security and flexibility, enabling traders to hedge, leverage, and speculate without relying on centralized intermediaries. The rise of perpdexes is fueled by technological advancements, particularly in Layer 2 scaling solutions, which enhance transaction speed and reduce costs, addressing previous barriers to on-chain trading. However, these platforms face significant challenges, including the need to attract sufficient liquidity to compete with centralized exchanges and improve user interfaces for wider adoption. Regulatory uncertainty also poses a risk, as governments explore how to oversee these innovative financial instruments. Despite these hurdles, the competitive drive within the DeFi community is fostering rapid innovation, with the potential to redefine the landscape of derivatives trading in the crypto world. As the market for decentralized perpetual futures exchanges expands, the focus will be on innovation, security, user experience, and community engagement. The platforms that effectively balance these elements are likely to dominate the space, attracting and retaining users in a rapidly evolving market. This development signifies a shift towards a more open and user-controlled financial system, positioning perpdexes as a critical component of the future of crypto trading.
Ashish Gupta, Chief Investment Officer at Axis AMC, advises investors to adopt a diversified investment strategy rather than chasing past equity returns, particularly after a volatile year in the equity markets. He emphasizes the importance of maintaining equities as the core of a portfolio while incorporating uncorrelated assets like gold, silver, and real estate investment trusts. Writes, to mitigate risks associated with global uncertainties and currency fluctuations, Gupta's remarks come amid expectations of improved corporate earnings and GDP growth in India, driven by policy support such as rate cuts, tax relief, and GST reductions, along with stronger rural demand. Gupta warns against expecting the exceptional equity returns of the past 5 years to continue, suggesting investors temper their expectations and focus on a 3-year portfolio strategy that balances optimism around India's domestic growth with realistic return projections. He underscores that the key is not to choose equities over other assets, but to determine the appropriate allocation for each within a diversified portfolio. Additionally, he advises against making long-term investment decisions based on short-term global headwinds, such as tariffs and shifting U.S. policies, and instead encourages focusing on India's structural strengths and competitive sectors.
Indian stock markets continued their downward trend for the 4th consecutive day, with the BSE Sensex and NSE Nifty indices closing lower on September 24, 2025. The Sensex fell by 386.47 points, or 0.47%, to close at 81,715.63, while the Nifty dropped 112.60 points, or 0.45%, to 25,056.90. This decline was largely attributed to profit-taking in banking, auto, and capital goods sectors, alongside foreign institutional investor (FII) outflows. FII's offloaded equities were 3,551.19 crore rupees, as per exchange data, amid concerns over H-1B visa fee hikes and ongoing U.S. trade negotiations. The market sentiment was further dampened by India's high valuations and moderated earnings growth, prompting FIIs to reduce their positions. Additionally, global cues, including weak performances in the U.S. markets and fluctuating Asian indices, contributed to the cautious investor mood. The rupee showed resilience, recovering from early lows to settle almost flat against the U.S. dollar at 88.72. Meanwhile, Brent crude oil prices rose slightly to $67.93 a barrel. The broader market indices also faced declines, with the BSE mid-cap and small-cap indices dropping by 0.85% and 0.50% respectively. Despite these pressures, sectors like FMCG managed to register gains, contrasting with significant losses in realty and utilities.
Ulta Beauty Inc., Nasdaq. Ulta has seen increased interest from institutional investors, with CX Institutional recently expanding its stake by 8.2% in the second quarter, now holding 424 shares valued at $198,000. This comes amid a broader trend of institutional acquisitions, as entities like American National Bank and Trust and Wayfinding Financial LLC have also taken new positions in the company. Currently, institutional investors own a significant 90.39% of Ulta Beauty's stock, indicating strong confidence in the specialty retailer's market performance. The company's recent financial results further bolster this investor confidence. Ulta Beauty reported a robust quarterly earnings per share (EPS) of $5.78, surpassing consensus estimates by 75 cents, and a 9.3% year-over-year revenue increase to $2.79 billion. Analysts have responded positively, with several raising their price targets. For instance, Morgan Stanley and Oppenheimer now project targets of $600. Ulta Beauty's strong net margin of 10.31% and return on equity of 48.78% highlight its efficient operations and profitability. The stock's performance, with a current price of $524.60, reflects its solid fundamentals and favorable market sentiment, as evidenced by the moderate buy consensus rating and an average target price of $543.13.
Alphabet Inc., Nasdaq, Google, continues to be a major focus for institutional investors, with mixed adjustments in holdings during the second quarter. Border to Coast Pensions Partnership Limited slightly reduced its position by 2.2%, maintaining Alphabet as its sixth largest holding, valued at approximately $201.6 million and constituting about 3.7% of its portfolio. Conversely, Palacios Wealth Management LLC significantly increased its stake by 134.6%, acquiring an additional 7,374 shares. making Alphabet its 13th largest holding at a value of approximately $2.27 million. Similarly, Matrix Trust Company boosted its stake by 48.4%, reflecting a broader trend of increased institutional interest in Alphabet. Alphabet's financial performance has been robust, reporting a quarterly revenue of $96.43 billion, surpassing consensus estimates of $93.60 billion, and achieving earnings per share of $2.31, exceeding the expected $2.15. The company's net margin and return on equity are strong at 31.12% and 34.31%, respectively. The market sentiment remains positive, with analysts maintaining a moderate buy rating and price targets as high as $280 from Citigroup, indicating confidence in Alphabet's growth potential. The stock opened recently at $251.66, with a market capitalization of $3.04 trillion and a P/E ratio of 26.80. Despite some insider selling, including transactions by CEO Sundar Pichai and Sao Amy Thuner O'Toole, institutional confidence remains strong, as evidenced by increased holdings from major investors like Nuveen LLC and Vanguard Group, Inc. Alphabet's strategic diversification in Google Cloud and advertising continues to drive growth, supported by a newly announced quarterly dividend of 21 cents per share. These developments underscore a stable and optimistic outlook for Alphabet, bolstered by its strategic initiatives and market positioning.
Meta Platforms, Inc., Nasdaq, Meta, has recently seen increased interest from institutional investors, with Hilltop Wealth Advisors LLC boosting its stake by 5.6% and Bouvel Investment Partners LLC increasing its holdings by 0.6% during the second quarter. These moves contribute to institutional investors owning approximately 79.91% of Meta's stock, reflecting strong confidence in the company's future performance. Despite Orrstown Financial Services, Inc. reducing its position slightly by 1.9%, the overall trend among institutional investors remains positive. Meta's recent quarterly earnings report revealed robust financial health, with a 21.6% increase in revenue year over year, totaling $47.52 billion, and earnings per share, EPS, of $7.14, surpassing analyst expectations. The company's strong performance has prompted several analysts, including those from HSBC, Sanford C. Bernstein, Stifel Nicolaus, and Loop Capital, to raise their price targets, with some reaching as high as $980. Despite these positive indicators, Meta's stock experienced a slight decline of 1.3%, trading at $755.40, amid broader market volatility. The company maintains a strong market capitalization of $1.90 trillion, a P/E ratio of 27.35, and a beta of 1.24, suggesting moderate volatility. Meta announced a quarterly dividend of $0.525 per share, yielding 0.3%, with a conservative payout ratio of 7.60%, indicating potential for future growth in dividends. Insider activity has been notable, with significant stock sales by key executives like CEO Mark Zuckerberg and CFO Susan J. Lee, which may indicate profit-taking at current high valuations. Meta's strategic focus on expanding its family of apps and Reality Lab segments continues to drive optimistic forecasts, with analysts predicting an EPS of 26.7 for the current fiscal year. The company's strong return on equity of 39.33% and net margin of 39.99% further underscore its financial resilience and operational efficiency. Overall, Meta's solid financial performance and strategic initiatives maintain positive market sentiment, despite minor fluctuations in stock price.
Arista Networks, Inc., NYSE, ANET, has seen a notable increase in institutional investment, with Wedge Capital Management LLP NC recently acquiring 2,074 shares valued at approximately $212,000 during the second quarter. This move is part of a broader trend, as other institutional investors such as WesBanco Bank Inc. and CX Institutional have also increased their stakes in the company. Arista Networks, a leading provider of cloud networking solutions, reported strong financial performance with a 30.4% year-over-year revenue growth in its latest quarterly earnings. The company achieved a net margin of 40.90% and a return on equity of 31.05%, surpassing analyst expectations with an EPS of 73 cents against the consensus estimate of 65 cents. The company's stock performance has been robust, with its shares opening at $143.82, reflecting a significant rise from its one-year low of $59.43. Analysts remain optimistic about Arista's future, with a consensus rating of moderate buy and a target price of $157.88. Recent analyst activity includes Melius Research and Barclays raising their price targets to $185 and $179 respectively, indicating confidence in the company's growth prospects. However, insider activity shows some caution, as CEO Jayshree Ullal sold a substantial number of shares totaling over $243 million, which could influence market sentiment. Despite this, the overall outlook for Arista Networks remains positive, driven by its strong financials and strategic position in the cloud networking sector.
Farther Finance Advisors LLC has increased its stake in Prudential Financial, Inc., NYSE PRU, by 5.1% during the second quarter, as per their latest SEC filing. The investment firm now owns 12,759 shares valued at approximately $1.37 million. This move follows a trend among institutional investors, including Gamma Investing LLC and Goldman Sachs Group, Inc., who have significantly increased their positions in Prudential Financial in recent quarters. Notably, Goldman Sachs expanded its holdings by 19.2% in the first quarter, reflecting continued institutional confidence in the financial services provider. Prudential Financial has demonstrated solid performance with its recent earnings report, posting an EPS of $3.58, surpassing analysts' expectations of $3.22. Despite a 2.5% year-over-year revenue decline to $13.50 billion, the company maintains a robust return on equity of 15.80%. The stock opened at $103.06, with a market cap of $36.28 billion, and continues to offer a compelling dividend yield of 5.2%. Analysts have a mixed outlook on the stock, with a consensus hold rating and an average price target of $122.08, suggesting cautious optimism about its future performance amidst market volatility. Prudential Financial's strategic focus on diverse segments, including PGIM and retirement strategies, positions it well in the financial services landscape. The firm's ability to deliver consistent dividends and maintain strong institutional backing underscores its resilience and attractiveness to investors seeking stable returns. However, with a high dividend payout ratio of 119.73%, the company may face pressure to sustain its dividend policy if earnings growth does not align with expectations. This dynamic, coupled with varying analyst ratings, suggests that stakeholders will be closely monitoring Prudential's strategic maneuvers and market conditions in the coming quarters.